Hello there. Welcome to our webinar. My name is Christina Acosta with MoneyWise Retirement Planning. Today, I want to talk to you about a topic that's probably been on your mind for a while, but you really don't know how to address. Long-term care for many of our clients is something they worry about and actually experienced with their parents or loved one. And you know exactly the high cost of this type of care. So I'm going to address a solution that can eliminate the traditional obstacles in purchasing a long-term care policy and why many people have not looked into that. So I do want to preface this by saying that if you've owned a long-term care policy for more than 10 years, you're probably going to want to hang on to that. But if you'd like to talk through that a little bit more, I'd be happy to do that. But I'm going to start off by addressing some of the typical obstacles in purchasing a long-term care policy. The first obstacle is that you have to qualify medically. So you're going to have to go through a medical. They oftentimes will order doctor's records, and this can present a challenge that for some people, they really don't want to go there. But even if you are approved, maybe based on some pre-existing conditions, you are assessed a rating, and a rating is going to increase the cost that you will pay for that policy. So just going through the medical underwriting can be a challenge. The second obstacle is you are committing to a lifetime premium that you're going to be paying for this policy. And by the way, the premium can go up over time and probably will. So that can present a big obstacle for budgeting this cost in long-term into your retirement. And the third obstacle is what if you never use the coverage, right? You're paying for this policy for many, many years, and you purchase something that you may not ever use or use very little of the benefits. So that presents a big challenge. Even with the life insurance option with the long-term care rider, can present a challenge too, because you do need to qualify medically for the policy. You may not experience the premiums going up if you purchased a permanent policy, but you still have to go through the underwriting process as well. So I wanted to research a solution that I could present to clients that could help eliminate these traditional obstacles. And I found a solution. It's through a company called Equitrust. And this is what you need to know about it. First of all, there is no medical qualification. What will happen is you will go through an interview, an online interview in your home, and it'll take anywhere from 30 to 40 minutes. And there's going to be really two bases for this interview. There's going to be a physical and a cognitive basis. So the physical is pretty straightforward. They want to see if you're upright, right? You can get up, you can get down. There's no physical limitations, and that's pretty straightforward. The second is going to be more of a cognitive interview where they're going to ask you some questions. They're going to really look to see if there's any significant cognitive decline in the person, and they're going to ask you to recite some things that they've asked you early on in the interview. So once you finish that interview, they're going to come back with a rating, and the rating is going to be based on three classifications. It's going to be a basic, a standard, or preferred. And this rating is going to be really important because it's going to offer you a multiplier that's going to be really the engine of what the benefits are that you are going to be able to get down the road. So I'm going to ask that we put that multiplier ratio on the side for a moment, because the first decision is how much you're going to invest into this account. So it's simply about transferring dollars from one bucket to another. And these dollars have to be after-tax dollars. So that means you can't fund it with IRA money or 401k money. It has to be post-tax dollars. And you're funding this into a vehicle called a fixed index annuity fixed index annuity, which many of our clients are already using for their retirement. So how it works is you invest an amount that you feel comfortable with, and the minimum amount is $50,000. So let me give you an example of how it would work. So let's just use a minimum. You invest $50,000 into this index annuity, and that is going to grow in that account. And it's going to grow by interest that's linked to an index of your choice. Oftentimes it's the S&P 500 that's selected, and you're going to earn interest up to a cap, and the current cap's 9%. So let's just say a person invests into this at 60, and they let this grow for 20 years. And we're going to use in this example a very conservative interest rate. And that 50,000 over that 20 years is going to grow to 100,000. Now you're in your 80s and you're starting to have some health problems. The only qualifier to access this benefit is that you cannot do 2 out of 6 activities of daily living, and that will qualify you for the benefit. Activities of daily living consist of eating, bathing, dressing, moving around, so on and so forth. So let's bring in that ratio multiplier again. So 20 years ago, you qualified for the preferred rating, which gives you a 3 times multiple. Okay, on average, a 3 times multiple. So your 50,000 grew to 100,000. Now they're going to multiply that account value by 3 times. So now you have a benefit pool of 300,000, which will be paid to you in level payments over a period of 60 months. And the beauty of this benefit is that you do not have to be in a qualified facility. You do not need the care of a licensed professional. In fact, it can be a family member, including your spouse, that can be paid for this care. But the beauty of this option is that if you don't ever trigger the benefit, your account value is still accessible to you, or it can be left to your estate. So this is what I have found to be a viable option for someone who wants to address long-term care in their plan, but really eliminates the traditional obstacles from purchasing a long-term care policy. So if this is something you'd like to discuss a little bit more with us, there's going to be a link in this email that you received to schedule a time on our calendar, and we can talk this through a little bit more. So thank you for your time in attending this webinar. Bye-bye.